Verbo? Oh, yeah. Wunderbar. Okay, all right. Thank you so much for being here during lunch hour. They gave me the worst spot, but that's all right. I'm very excited today to talk about the topic. It came with many titles on the program. I decided companies are bought, not sold. Right? We talk a bit about how to exit startups, what to keep in mind when you want to sell your startup, but also very importantly, I see this as sort of a platform to do some knowledge sharing and the perspective also from VCs. What do we think about when we think about exiting startups? Right? I think it's an underappreciated topic, but it's also very much the right time for us as Swisscom Ventures to talk about how to exit startups as we are institutionalizing the process more and more, refining and essentially establishing playbooks, if you will, of how to get the most out of a startup for the founders, very importantly, and also, of course, for our investors on our side. If you've had plenty of exits, and then you're not going to learn much here. But if you're a bit new in the game and you want to think about that in a structured way, then I hope this is the right place for you to be. Just quickly about me and about Swisscom Ventures. Swisscom Ventures, we're the VC arm of Swisscom, but we're very much operationally independent. That's because we manage a lot of pension fund capital, right? So you can see here, these are the commitments we received from Swisscom over the lifetime of Swisscom Ventures in 2007. And then we have two funds, one launched in 2018, one launched in 2021, where we have a lot of Swiss pension fund capital that we're managing. So we're not a strategic investor, we're a financial investor, but of course we have a business development team that makes introduction to Swisscom and throughout Swisscom, wherever we can create value for our portfolio companies or even startups that we come across and we think are amazing, but we might not invest in. And so that's how we are connected to Swisscom. We've invested in some fantastic startups all over the world, but 50% of the capital is invested in Switzerland, and there we have some of our most amazing companies. In a session previously, Clea, who just entered, she was speaking to one of the guys at Anybotics, a startup we're very proud of. We have EcoRobotics, Flyability. You see a lot of robotics and deep tech stuff happening there. We also have, of course, Candid, SUD25, Yoko, you might have heard about earlier this year, having their acquisition done by TravelPerk. About me, I'm an investment manager at Swisscom Ventures. I joined last year. Previously, I worked in a strategic finance team in one of the largest startups, fintech startups in Southeast Asia, and that was super fun. We had a lot of transactions, a lot of spin-outs, minority investments, carve-outs, and whatnot. My background is originally law, and I put a picture there of myself because this is how I hope you remember me, because I look much better here than I look now. Okay. Awesome. Just quickly, something about the market. I think you've all seen this a million times. But anyway, global IT M&A activity was, of course, at an all-time high in 2021 and a bit in 2022. It went down. Now we're back a bit. So we see it, for example, when Alphabet acquired Wiz for 32 billion early this year, a large Israeli cybersecurity company at, I think, a 40x revenue multiple. Super exciting. Unfortunately, it doesn't happen all the time, but we're slowly climbing our way back into an exit market. It's not quite as exciting as before. I think what has to be said is a lot of these deals are also distressed sales. Right, so not all of them are 40x revenue multiple exit deals. This is on the M&A side, and this is also what we see for some of the global IT M&A EV revenue multiples. Right, this is how do you value a company. Oftentimes you look at the revenue, and then you evaluate by a multiple of the exit. So we see in 2021, of course, companies were on average valued much, much higher. Now we're back at sort of pre-COVID revenue multiples. So things are slowly starting to normalize again. And these are public company valuations, right? Again, EV revenue multiples, just as a sort of one of the signals that we can take is, again, 2021, super high valuations of publicly traded companies, sometimes even in the 75th percentile at 40x, and then slowly they're coming down again, and they're now stabilized there. Stabilization is really important. A stable environment is super important for exits, and we'll talk a bit more about that later. Just quickly, very importantly, most of the exits that happen are M&A, right? So we have between sort of 97%, around 95% of all the exits of European companies are M&A. They're not IPOs. We hear a lot about the IPOs, but that usually doesn't happen too often. Now, of course, I talked about the stable environment. We still have a lot of wars going on, right? We have a lot of Trump stuff happening, both in the US. We have Panama. He wants to get Greenland. There's Canada that he wants to merge and acquire as well. And then we, of course, have a lot of other conflicts that are happening. These are just the regions with conflicts that are directly highly relevant for the deep tech industry, right? A lot about supply chains, and of course, Russia and Ukraine is impacting a lot. The only positive thing about this map is actually, I looked at this and I thought, oh, the Middle East conflict is not that large anymore, at least visually. But of course, it's a very important thing that's happening at the same time too. So all of this is sort of creating an interesting M&A environment where acquisitions happen, but we're not yet seeing the bull runs of 2021. So thinking about exits in a structured framework is more important than ever before. Now, I wanted to talk first about, well, primarily this presentation is going to be about M&A exits, right? Not so much IPOs, because as we saw, IPOs are not going to happen very often. But there are essentially three types of M&A exits. There's the acqui-hire. That's a very early exit. It's when the team is amazing, and say, Google, for example, acquired Kaggle, and they said, well, this is a great team, we want them. There's not a lot of tech yet there, there's also not a lot of traction, but we really want these guys with us, so we acquire them. This is not a very profitable exit usually for VCs, but it's great for the team, it's an early one, they get a lot of stock options, and they get to work for another company. Then we have a tech exit that happens a bit later, when they say, wow, the tech they have built is truly one of a kind, right? For example, Amazon's acquisition of Ring, they say, if we take this and we put it into our distribution network, we can scale this properly. There's not yet a lot of traction, but the technology promises so much value. And so this is often driven by a build versus buy decision-making process. And they say, no, if we have to build Ring, in this case, ourselves, it would take much longer. And so the exciting thing is here, it's not valued by EV revenue multiples or financials. It often comes with a higher technology because it's so hard to replicate. Maybe it's protected by intellectual property laws, etc. And then finally, we have the traction exit, of course. For example, when Facebook acquired Instagram, they said, well, Instagram has millions and millions and millions of users. We want those users. Instagram is, on a technological level, not very defensible at all. And I'm sure the team was great as well, but ultimately, it's all about acquiring a lot of customers, right? And that's later stage in the process. And they all have different characteristics to them. But it's important to keep that a bit in mind. And we'll see those three types of exits come up later again. Exactly here. So first of all, this is a slide I have shamelessly adapted from Menalto Advisors, an investment boutique advisory firm that sometimes I work with. They're based in Zurich and Silicon Valley. They say great artists don't copy, they steal. So I stole this and I made it slightly worse. So this is what we're looking at here. What do we see on this graph, right? We have the value of the company on the y-axis and the time that the company exists on the x-axis, right? And so the thing that we spoke about earlier is acqui-hire, very early stage type of acquisition. A company just got initial funding, it's all great. Google comes in, buys Kaggle and says, yes, we want the team with us. Then we start to get early traction. Okay, very interesting. All of a sudden you have something to show for, right? I'll give you an example. SpaceX, for example, they don't really have a huge amount of of revenue at the moment, right? They're far away from being a profitable company. But at the moment, if they were to be sold, and why everyone wants to invest in them is because they have a huge amount of promise value. Right now, they promise the world that they will own space, right? And they caught the rocket in the air. And if you catch a rocket in the air, this is where you want to sell a company if you think about an exit, right? Of course, you can continue to build, in the case of SpaceX, and actually go dominate the space, but this is much harder to prove. If you're in this for the money, this is a very exciting time, right? Because once you catch the rocket, everyone says like, oh, that's super cool, but at some point, you know, you have to start scaling the financial side of the business as well. Afterwards, and this is what we see quite often in the European startup ecosystem. You have this amazing moment, you get a lot of excitement. Wow, there's a technological breakthrough. Well, snap back to reality. You need to scale sales and marketing. You need to scale OpEx. And now you're starting to be valued by the traction, by how many customers you have, by how much revenue you generate, right? And it's no longer the promise value area where you have a tech exit, right? I'm not sure if you guys ever watched the TV series Silicon Valley, right? They say like, why would you ever start, you know, generating revenue? All of a sudden you're going to be valued by revenue. There's never enough revenue, and it keeps going on like this. This is exactly that time. So it's a bit the valley of death, where you raise a very large round on the promise value. You have to start scaling your team, and it doesn't go so well. Right? So this is a very tricky area. But if you're successful, of course, you start building up a bit of traction and you exit for the financial value, the traction exit. You start having a significant business. As Instagram, you're a huge, you know, network of people. You attract a lot of people. It's fantastic. You have a fantastic exit there. And then finally, if you don't do this, you start preparing for an IPO. Again, when we talk to M&A advisors at the moment and investment banks, what we see quite often is that in order to have an IPO, you need to have 100 to 200 million of revenue. You need to be EBITDA positive for about 6 quarters, and you need to essentially be a gigantic business already. The times where Uber would go public, you know, and where they keep losing money for years, those times are over, at least for now. So that is why it's a relatively unlikely scenario for a lot of the large tech companies we see at the moment. So who will buy your company, right? I think this exercise of understanding who might be your acquirer is really important for every board member, for every founder to go through on a regular basis. Because essentially what you're doing is you're trying to understand the market. This should be quite an easy exercise for you to do at any point in time. You need to understand who are the potential partners. Where can I sell my products? Who's my distribution channel? Those are people that see the synergies. Who's a potential customer, right? Who understands the value proposition of the technology that I'm building, and who's a potential acquirer in the sense of who has the financial means for an acquisition. Just because you build something amazing doesn't mean that anyone has enough money, capital, or even the culture to buy companies and integrate them afterwards. And then the sort of parties that combine all 3 of those, they are right there in the sweet spot. So that means that what you need to do is you need to build strategic relationships and trust. That's a process that takes a long time. We'll talk about that. You need to regularly do targeted buyer mapping and engagement, and you need to do long-term engagement and face-to-face interactions, right? Nothing beats face-to-face interactions, especially in these days where everything is otherwise online. These are things, again, this is from the VC perspective. This might not be something you think about at the startup all the time. You're building technology that's changing the world. But this is where your VC, your board member, they're supposed to come in and help you with this. This is what we do with our companies. And even though we're not thinking about exiting companies constantly, it always helps us to understand the market much more and the different dynamics. This is sort of how we think about the relationship funnel and how we build those relationships, right? Early on, and again, if you think you want to exit at some point, it's not going to happen overnight, right? Companies are bought, not sold, is what the newest title is of this presentation. That means that you can't just go to people and say, hey, by the way, do you want to sell my company? I'd like to get an exit in 6 months. No, you need to think about this from a very strategic point of view. You need to create awareness early on. You go to amazing events, the startup days in Bern, you go to Slush in Helsinki, and you show people that you interact, right? And then you start doing early interaction, just like with any customer, right? You have pilot projects, POCs, etc. And by the way, these are the numbers of companies you might engage with. This is just an example. And then at some point, some customers just use you because your technology is quite handy and it helps them make a few things more efficient. But really, with a few customers, you want to be strategically important. They start co-building projects with you. They start launching some products together in cooperation with what you've built. And then, very importantly, regular engagements. You keep understanding their point of view, and you talk to the corporate development team, but you also talk to the head of products. Where do you see the company go in a few years? And then finally, at some point, just like a miracle, you get acquisitions offers. Well, it doesn't work exactly like this, but of course, if you manage to have a personal relationship with people, you maybe had a joint venture or their distribution channel, or you offer them critical tech that they use, right? If you work with a robotics company and you provide them with the best sensors in the world, then of course they would never want to lose you or lose your technology, especially not to a competitor. So at some point they think, oof, I'd like to really keep this for myself. Someone starts showing a bit of interest, and then you engage your board, you engage your M&A advisor, and you say, hey, let's start a process. If Apple is interested in my technology, maybe so is Samsung. So I start talking to Samsung. If Google is interested, maybe I should also talk to Microsoft, right? And you start getting a process. You never want to engage with just one potential interesting party. We also talk about that later. You never want to sign ROFRs, right? You never want to give someone the right to buy you, legally give you the right to give them the right to buy you. You know, the first purchase right, if you will, because that completely ruins the process. In order to get the best exit, you want the process where many people are on equal levels, many parties, and they all need to submit very competitive offers. If you now have a strategic investor, right, and you say, oh, wow, that's so amazing, this huge corporate, they signed a little check, they gave me 5 million, they really understand what I'm doing, and I've also given them the legal right to purchase us later. This is exciting, it's an indication that they would like to buy us later. Horrible mistake. Don't do that, because they will buy your company without any competition. Another acquirer comes and they says, oh no, but I can bid, I can put in so much work, and then whoever else can come in and just purchase the startup outright. It ruins a great exit, and it ruins all the years of work that you've done. So a few guidelines to keep in mind. Do communicate your unique value proposition succinctly and regularly to the partners that you work with. Don't become too reliant on a single partner, right? Work with a lot of people and a lot of partners at the same time. Help potential partners reach their strategic goals, so engage with them. Understand not just from your perspective or just in this project what's happening, but beyond that, how do you see the vision of your company? And maybe you fit into that strategy quite well, but do not miss milestones that were communicated. You're trying to build trust. Be open, be honest. Don't tell them things that you're not going to be able to deliver on. Identify key decision makers and sponsors early on. I think that's an obvious one. Do not provide exclusive technology licenses. There are some exceptions to this, but typically, again, you lock yourself in if you do this. You do never want to lock yourself in. It destroys a competitive M&A process from the start. Engage with the strategy teams and the business teams early on. So strategy are the ones who are probably going to buy you and think about the big vision of the corporate, but business are the ones who have a budget for POC, who drive the product vision, who are much more in the nitty-gritty. And exactly. And then very importantly, and this is often neglected, have a long runway before you enter into an exclusivity period in an M&A process with a potential acquirer, right? What we see all too often is you have a process. You talk to 3 parties at the same time. Okay, it's very nice. The offer goes up and up and up, and at some point they say, okay, Google has the best offer. I'm only going to talk to Google. They do a deep dive due diligence for 3 to 6 months. Usually more like 3 months. You're not allowed to talk to any other potential acquirer, and that sounds great, nice. We're essentially going to get married. But the problem is that they are going to extend the due diligence period, right? They are going to start finding issues that were obvious before. They know that now, the time, they have all the leverage in the world, because you're a startup, you're most likely losing money, right? And you have a runway of maybe 6 months, and they say, oh, I'm not so sure. We saw some tech debt. I don't think that fits very well. We need to get another buy-in from the group level. Maybe it doesn't really fit into our product roadmap. Look, and I think with a few issues that we saw, we're going to reduce the purchase price by 20%. And in the meanwhile, for 6 months, the founder team has only been focused on the exit process. They're slowly starting to get stressed out. They're missing commercial targets. They didn't have time to acquire new clients. They're fully focused on this exit process. And this is where all of a sudden the price starts to drop, right? And they really put a lot of pressure on you. And this is when they get you, and your exit becomes much less exciting. And that's why you need a long runway, a lot of endurance, before you engage in such a process. And on the board, you should always look for experienced investors who've done many exit processes before and led them. And that's what we have at Swisscom Ventures. Oops, wrong. Yes. So I also want to do, I know this is quite dry and boring and not as exciting as some of the other presentations, but still, I put together a bit of a storyline for how an exit might go, and also why raising more than you need might not always be good for you, right? There's always this argument. Startups say, oh, I want a high valuation, I want a lot of money, right? Why not? And VCs say, no, don't do that. It's not always good for you. And they always argue. So I put together a few numbers, and I hope that you maybe afterwards understand our perspective a bit more, right? So this is why raising too much money will ruin your exit further down the road, and why you should already think about these options now. So the story is, this is a very exciting SaaS company, right? Software as a service. They're founded, okay, that there is not much happening there. Then they raise a Series seed. They have no revenue, but the 20 million pre-money valuation, they raise 5 million. Yay, super awesome. This happens all the time, right? And then Series A, by the way, the founder shareholding is from 100% diluted to 80%. That's super awesome. That's usually in line with what happens in the market. You have a Series A, 50 million pre-money valuation, you raise 10 million, you're now at 67% of the company as a founder, and you have 1 million revenue, you have a 50x EV revenue multiple. Remember the multiples that I showed you earlier, right? 50x. No one buys companies for 50x, or very unlikely. I mean, Google bought Viz for 40x, okay, but it doesn't really happen that often. Very exciting, you raise money at that valuation. Why shouldn't you? You have very little dilution, and then you have 5 million revenue. You have a 200 million pre-money valuation at the Series B. You raise 40 million, 240 million post-money valuation, and it's a 40x EV revenue multiple, super awesome, and you still own 56% of the company. That is so cool. Everything is going really well. Now the problem is, think about again the graph that we showed. You here have the promise value. Very exciting. Your technology is going so well, and now you're approaching the valley of death. Maybe it's not going that well anymore. You start thinking about an exit, right? What does that look like? Successful fundraise backfires during the exit. We know that companies in SaaS companies are usually acquired, let's say, for an 8x revenue multiple. That's a pretty standard. We've had a lot of transactions in that region. If you look at a lot of market reports, I think that's fair to say that this is not unheard of, right? A lot of companies get acquired for that multiple. Now, in order to get to that 8x, right, and still have that 240 million post-money valuation, so 240 million, 8x, you need to reach 30 million revenue just to get to a valuation at the exit level that you previously had at 5 million revenue. You need to go to 500% there. That's pretty tricky. You know, maybe you have someone who pays a higher multiple. That's always possible. By the way, I have a model that I put together. You can play around with these figures. I can share it later, and then you can correct me. But anyway, this is what is happening. You need to grow a lot to come to the same valuation that you had previously. Or you only grow a little, say 50%, which is also quite possible year on year. You end up at 7.5 million revenue. You have an 8x EV revenue multiple, and your company is now valued at 60 million, right? Now, what you see here in gray is what the investors get back. And what you see in blue is what the founders would get back. Where is this discrepancy coming from? It's called liquidation preferences. They're not your friend, right? When you invest in a company, when we invest in a company, very standard terms always is that we invest with a 1x liquidation preference. That means we first, in the case of an exit, we first get back what we invested, right? Always. If we invest 100 million in a company and we own 20% of the shares, but the company gets sold for 120 million, we get 100 million back. This is how every term sheet works. And as a founder, especially early on, you think, you know, whatever is a standard term sheet, I trust my lawyer. And it is very normal. But this is to show you graphically, this can come bite you in the ass if you raise it too high of a valuation and you're not able to deliver because you didn't think about what does the exit market actually look like. I understand there's always the case where you raise this round and you go on to become a unicorn, and you have a Viz exit, and you get bought by Alphabet, and everything is fantastic. But I still think it's only fair to show you a numerical example so you understand how it can go in another case as well, because I think that sort of sensibility for these cases is kind of missing, right? And what I want to show here still is, in these cases, right, if it goes very well, and you reach the 240 million valuation that you had after your last funding round, you get exactly in your financial returns what you had in shareholder in shareholding, right? But here in a downside case where you don't grow as much anymore, you still own 56% of the shares, but you get 8% of the returns. You spend 10 years as two founders to earn 5 million. It's a lot of money, don't get me wrong, but it's probably not what you signed up for. Very important, 56% of the shares, 8% of the returns. So that's why I also sketched another example. The first few years, they still work the same, right? You raise the same amount, you have the same dilution, but this time you're at Series B, and you've done all your research, you've done all the investor and acquirer mapping, you understand where the market is at, you understand, am I really going to become a unicorn, or is this more likely going to be a super nice acquisition by a larger company? I think that would be fantastic. You decide, actually, I don't need a 200 million pre-money valuation, but I still want the same dilution, right? So here they raised 40 million, 200 million. Now I'm going to raise 20 million on a 100 million pre-money valuation. The only thing that changes really is that the EV revenue multiple here is a bit different, but the founder shareholding is still the same. You only raised what you need. Very importantly, don't raise more than you need, because then we still know that you need an 8, that's probably going to get acquired at an 8x in order to reach the 8x and still have the same post-money valuation, and here you get acquired for 120 million. The post-money valuation here is 120 million. You only need to triple your revenue, which is already quite a lot, but only that. Or if you don't manage to do that and only grow 20% versus the 50% in the other example, so even if you grow less because you raised less capital, in an exit where you now have 6 million of revenue, 8x EV revenue multiple, 48 million, you get 13 million, which is way more than you had in the other example. Nope, that's not. 5 million, right? I understand these are a lot of numbers, and it can be a bit confusing. That's why, again, I have an Excel model that I'm very happy to share with you all, and you can put your figures in, and you can see whether that applies to your case or not. I don't want to stand here as a Swiss VC and tell you guys, don't go out there and build unicorns and build the next Microsoft and Google, right? But what I do want to do is I want to share a bit of insight and knowledge. These things can happen. Protect yourself. Really think about how much you need to raise. And make sure that you talk to your VCs and board members about this. Ask them to be honest. Go through a lot of scenarios. You owe it to yourself. They owe it to you as well. You put your life's work into this. You should have an understanding of what the different outcomes might be. Where do you stand? What is realistic? Why are we raising so much money at a higher valuation? Is it so that the VC can say, oh, look how great my portfolio looks? Or is it actually what I need for my company to be successful and for myself and my family to have a great future as well? Yeah, so just a quick excursion on that topic. Yeah, finally, also very happy to share the presentation, so you don't have to read all of this in detail now. But of course, if you want to have an exit, you need to have your financial and audit clean and ready. Key contracts need to be aligned. Tech, team retention, everything. I mean, just have a healthy company. Very importantly, oftentimes, you want to have at least 3 years of financial audits and a well-running company that really accelerates a process and makes it much easier. So yeah, in summary, if you want to be acquired at some point, build trust before you need it with a lot of different parties that you think are interesting for you. Exit on strength, not desperation. When you have a huge technological breakthrough, think about what this means for the future of your company. Don't overcapitalize until you can truly 10x, meaning only raise what you need. If you're a fantastic company, there's always more money out there. If you truly think you can grow, just raise what you need, you get less diluted, and it protects you in the case of an exit. Understand trigger points. Again, acqui-hire, tech exit, traction exit, but also the value of death. And think strategically by understanding the whole ecosystem and all the important players. Yeah, that's it. If you have any questions, if you want my model, my Excel, if you want the presentation, just let me know. This is my email address, and I'd be happy to talk to you guys. That's it. Thank you. Cool. By the way, this is the first time I put this presentation together. I think there are many more exciting topics, of course, but I thought a bit of knowledge sharing can never hurt. So also happy to get feedback via email. Anonymous is fine if it's hurtful. Yeah.